Hey guys, how's it going? It's Andy from Magoo Investing. Today I'm going to be talking about something that I've been trying to figure out the correct way to kind of format this video, and I finally found this article, and I'm going to be linking it down below after this, kind of explaining the importance of always sticking into the market. And so I've been kind of talking with my dad and the people that I live with, kind of that the market's been kind of boring. And I've been getting these notifications of all these companies that I follow and really have traded in the past hitting 52-week highs. And while that's great if you're in them, for someone like myself that considers myself to be kind of a value investor that likes to buy after bad news events, bad earnings, kind of when you're going to be able to get a stock at a discount, this is not a great time for me. So I don't really have any great opportunities to pick up any shares of companies that I love. And so I could just have my money just sitting on the side waiting. But from this article, it kind of talked about if you didn't have money in the stock market on the 5, 10, and 25 best gain days of the year, and how that would impact your account over the year. And then I think it went over 20 years. So this one kind of hurts for me, especially because towards the end of last year, at the end of December, I was actually shorting the market on the best day of the year. So this S&P 500 went up 5%. And so that's a great day for everyone else. Unfortunately, I was shorting it and got stuck in, that'll be a long story that I'll explain some other time. And I was in a 3 times weighted ETF. So I lost 15% of my investment because I made a really dumb mistake. I've learned from it and I'll make a video about that in the future. But so I missed the biggest day of the year. And according to this article that I found, if you missed it on the top 5 days of the year, over the course of the year, you'd be down around 2% of how much you would have made. And then over the course of the 20 years that they follow this, you'd be down almost 40%. So that's some serious change if you keep doing that all the time and you're kind of waiting for something to happen. And I talk about kind of waiting for these opportunities to go in and buy more shares. And so I originally was just kind of going to keep some money in my bank, just kind of be waiting for an opportunity. And I've kind of changed my approach now, which is kind of the beautiful thing about investing is you can change your approach. And if you find something that you enjoy better, is more successful, and it makes you feel more confident, you can do that. And so the way I've been doing this is I've been putting my money into a 3 times weighted ETF called TQQQ, which follows the NASDAQ composite, I believe, and is 3 times weighted. So this year's been really good for the market. Not a lot of variation going up and down, it's just kind of steadily been going up. And over the course of these past 4 months, I've been sitting in there and I've been making around, I think I'm up around 20% on the year already. And so I just have my money in there that's making me money. And until I find some reason that I should be putting my money into specific stocks, I'm just going to kind of be sitting in there waiting. So I think I'll link the article down below. I think it's a really good read, just kind of hitting home the idea that you need to have your money in the stock market. Pulling it out all the time and kind of waiting for your perfect opportunity is going to be kind of hurting you in the long run because you're not taking advantage of these 1% days that the market has. And if you do that a bunch of times over the course of the year, you're going to be really missing out. So I hope you guys learned something from this video, maybe kind of opened your eyes a little bit to the importance of keeping your money in the market and not overreacting and overtrading, because that's something that I really struggled with. I would make some money or I'd be down some money and I would immediately take my money out and look for a better opportunity. And sometimes you don't have these great opportunities that you can kind of take advantage of. And if you don't have any great opportunities, why not just throw your money into the market overall, into an index fund that kind of averages out the market as a whole instead of trying to pick one winner? Because if you pick that loser, you're going to be taking a big hit from that. Whereas if you have an index fund, we know the market tends to go up over time, so you're more likely to be successful. So hope you guys learned something. If you did, please hit that like button, and I will see you guys in the next video.